Thank you very much for that introduction, Michelle. Thank you all for having me back here this year. It's always a great trip to come down and visit Southern Oregon. I unfortunately don't get here enough, and I always think about that one on this trip. So this is a very clever title, right? Economic Outlook 2019. Now, I don't like to use the R word too much, but clearly this issue of recession has been on people's minds. And we see it a lot in the press. This is a chart from the Wall Street Journal. It says the average probability of recession in the U.S. economy in the next 12 months, and the estimate is 25%. And so I want to do a couple things today. I want to say, where really are we in this cycle? What does the economy look like right now? Is recession something we should be worried about? And then talk a little bit about why recessions are hard to predict. What is it about this event that makes it the butt of economists' jokes, makes the economists the butt of the jokes when it comes to forecasting recessions? So that's what I'm trying to get to today. There we go. There's just no recession happening right now. It's just not anywhere in the data. You really have to be looking at third or fourth quality data to sort of see that, a recession is right on top of us. A typical timing of recession indicators like payrolls, industrial production, income, manufacturing, trade sales, none of these have turned. And so if somebody says that the economy is in recession right now, that's just clearly wrong. I don't think there's any likelihood of that in the near future, very near future. And in fact, most of our indicators are really looking fairly solid. We get a new labor report tomorrow, so I'm sure you'll all be up at 5:30 with me in the morning for those numbers come out. We get the unemployment rate. The unemployment rate is basically at lows that we haven't seen since the late 1960s. Job growth, the green line here, is accelerated in the past year. Fairly rare for this late in the cycle. The blue line is labor force growth, which also has accelerated. Fairly rare for this late in the cycle, too. The economy has been so good that we've been really drawing workers out of the sidelines and into the labor force, and this is a great thing for a number of reasons. One is it really allows us to sustain the momentum of this expansion. Another one is that once we bring people into the labor force, we think that they'll stay in the labor force, that they'll be better skilled workers that are more likely to be part of the labor force going forward. So this has been all great news, and most economists have been very, very happy to see it. If we look at Oregon, it's certainly the case that some similar kinds of activity are happening. Initial jobless claims, very, very low levels. If we look at residential building permits, it's been a little bit off lately, but that's, I think, mostly a story about multifamily housing being a little bit weak, and that's not terribly unexpected, particularly in the Portland area. Employment services payrolls, generally an upward trend, a little blip in the data there. This is temporary help workers. We think that they're going to be the first fired and the first as you go into a recession. We're still adding temporary help workers. Hours worked in manufacturing has been down, and this has been something of a mystery. We've been searching for why this has happened because it's not really consistent with the rest of manufacturing data. It seems to be largely contained in agricultural or food manufacturing, and this might relate to maybe the crops came in early, so the manufacturing was early and throws off your seasonal effects. It might be related to some changes in Oregon law that restricts the number of hours that manufacturing workers can work under most conditions. So, but it's very much inconsistent with what we see in manufacturing data overall. So it's nothing really that I would say is worrisome. I'm not sure where I'm supposed to be pointing this. There we go. So thank you. Hold on. No, I'm not going to skip to the end. I have no idea where I am in this presentation anymore. Okay. Oregon indicators. All right, now I know. Oregon indicators. Okay. Job growth in Oregon it's a little choppy month to month. Local level data tends to be a little bit noisier. The general trend has been to slower job growth. We've seen this in many areas of the state. I'll talk about this, but not all areas of the state, interestingly. we kind of expected that as this expansion continued, it'd be harder and harder for firms to find labor, and the pace of job growth would slow. It's a supply-side constraint, and that has been the case. Certainly, by the time 2016 started to roll around, job growth just started to ease off. Not tremendously, but pull back a little bit, much closer to national levels. But nothing that would suggest that there's some recessionary concern. When I put these together in the Oregon Economic Index of Economic Indicators, and I thank Michelle and KeyBank for being a sponsor of this project, again, the numbers are mostly sideways, and that's good. We're really looking for strong downtrends before you get to recessions. It's been a little bit down. However, again, that's really been driven by this hours worked component, which I think is really not that likely to be a problem. And then my measure of economic activity suggests that growth is maybe slowed a little bit in Oregon, but still at a fairly rapid pace. So when I look around the Oregon economy, when I talk to people in the Oregon economy, I don't get really some sense that there's been some dramatic change in the last 6 months that we need to be terribly worried about. I would say the same thing locally, too. Unemployment rates here are very low. If any of you are trying to hire workers, I'm sure you felt the challenges of finding that perfect worker. Well, that perfect worker is gone. You have to reach out to workers that maybe were not so perfect. Residential building permits have picked up, but again, they're fairly low. This is a fairly persistent problem for many parts of the state, so there's nothing I think would be new. It's there. The civilian labor force has continued to grow. A couple parts of the state, it's been a little bit weaker. This is the issue of to what extent we're finally hitting into some of these supply-side constraints in the economy. And if you look at the plane activity, very strong traffic in and out of the region's airport. That's consistent with an economy that's continuing to grow, continuing to add new residents, when those residents have the means and the interest in travel. So those are all been very, very solid indicators. If I look at job growth, Medford area's job growth has slowed down a little bit. I've seen the same thing in Eugene. I suspect that this is more of a temporary data issue than anything really fundamentally underlying the economy. I think that probably most of the state is growing pretty close to the U.S. average. Salem's growing a little bit faster. Bend's growing a little bit faster. Eugene is a little bit slower. I don't think that there's some, again, change in the dynamic. If there's an issue, I do still think it's more of a supply-side issue, that firms are just not able to hire in this environment. So I kind of look around this data and say, job growth has slowed a little bit, but on average, Medford's economy is probably growing about where it should be. Not terribly fast, not terribly slow, about average relative to what we've seen in the past. And so I have a hard time getting terribly worked out about a recession. But people do get worked up about recessions. So this is a Google search. People being interested in recession, and you can see it spiked at the end of this year. So people are clearly interested in this topic. Now, I wanted to see how interested they were, really, how passionate they are about a recession, right? And then I looked at a longer time series, right? And so you can see that where we are now is a little bit of spike in interest in recessions, but not anything like we saw during the 2007, 2008, 2009 period, right? Where we had very high interest in recession because, guess what? We were actually in a recession then, right? That big spike in the beginning is actually December 2007, which was the month that the recession started. So I'm pretty interested to see if we get a big spike again, and that becomes a predictor of a better real-time predictor of recessions. But what we're seeing right now is really not that much in comparison to interest in the past, which would suggest to me that some of the interest is not really terribly sincere. I also graphed this against something that really is important. Google searches for Oregon Ducks football. And you can see that Oregon's Ducks football is clearly much more important to the country than topics of recession. And only during the actual recession did people care more about a recession than Oregon Ducks football. So clearly this can't be too important of an issue, right? Okay, so, but then why? Why do people care about this? Why has this been such a concern lately? And one obvious reason is that the stock market hit a wall in this past quarter. Certainly, most of you who might have made the mistake of opening up your 401k statement, right? Don't do that. When you know the market's falling, why do you open up your 401k statement? That just doesn't work, right? So you know, in following the news, that it was fairly traumatic. Particularly December was a fairly traumatic month for the stock market, and as the joke goes, right, the stock market predicts 12 of the last 5 recessions, right? So something is going on. I mean, the stock market does give you some signal that something has changed in the economy, perhaps, that we should be wary about. And what are those things? Well, this is a fascinating chart. This shows analyst expectations for earnings growth, for S&P 500 earnings growth. And it's often the case that analysts start the year thinking earnings growth is going to be about 10%, right? Which also is kind of a red flag. Maybe analysts aren't really thinking about it too hard, or writing 10% down in their column, and that's it. In most years, then, analysts become a little bit less optimistic. The green line here is 2018, right? 2018 expectations started just to jump higher and higher. Well, that's because the tax law cut corporate taxes, right? So earnings had to jump up. And so you can really understand why stocks were supported in 2017 and 2018, because earnings were really strong. The black line here is expectations for 2019. And now 2019 has reverted to sort of the past patterns where earnings expectations are falling as the year progresses. So it's a very stark contrast between expectations for earnings last year and what's going on this year. And that's certainly one thing that I think is weighing on stock prices right now. Oh, no. Another thing, well, hopefully I'm in the right place. We'll find out. Okay, another factor is the strong economy itself is causing margin compression for a lot of firms. And maybe you feel this, maybe some of your firms feel this themselves. One problem is that firms have a hard time raising prices. Most firms are finding that consumers aren't accepting higher prices. We've got it built into our consumer mentality that we're going to get no more than 2% price increases every year. And if you try to make us take a 2% increase, we're just not going to buy your product. So prices have been challenged. But on the other side of that, costs keep rising. So labor costs have definitely been rising for most firms, right? So if you can't raise prices and your labor costs are going up, you're in a margin squeeze. And there's probably some of that going on in the background too. To the extent that firms can offset some of that margin squeeze by increasing productivity, by new technology, those are good things. They don't seem to be happening as much or as quickly as I think firms would like. So I think that's another reason why in a good economy you can see a softer stock market, just because that margin squeeze is there. That's not necessarily a bad thing for workers. It's a good thing for workers. Lots of jobs, rising wages. But for firms, it becomes a challenge. Don't go. Okay. Interest rates a little bit higher. That's been a factor, some of the lagged impact of monetary policy. This is for 30-year fixed mortgages. Now, of course, if you're more of a vintage homeowner like I am, you remember higher mortgage rates in the past, and you might say, well, 5% mortgage rates, well, what's the big deal, right? Well, the difference between, a 4% and 5% mortgage rate is actually, a 25 percentage point increase, or 25% increase. It's non-trivial. And so that may have been weighing on housing markets toward the end of last year. So this is new single-family homes sold. This data was just changed this morning and actually is a little bit brighter. Single-family homes have just bounced up a little bit. So probably at the end of last year, we saw higher interest rates. We saw a little bit lack of confidence with the stock market. And as a result, there was probably some caution in the home buying market. I think some of that has been eased as the quarter went on, especially as sort of rates stabilized and actually have trended down recently. But certainly, housing downturns have been associated with recessions in the past. And so there is, of course, concern when housing looks a bit softer that, yes, you're heading into a weaker point in the economy. There's lots of other things, right? The lagged impact of higher interest rates, fading fiscal stimulus, slower global growth, particularly in China. You have the concerns about Brexit and what a hard exit from the European Union would mean for the British economy, the European economy, and the global economy. You have U.S. policy uncertainty, you have the shutdown, and you have trade policy that also has a lot of uncertainty provided for it. So we look into 2019 and we say there's lots of reasons to think that economic activity will be slower. There's a lot of reason for some concern out there, and I think it's reasonable to think that growth is going to be slower. We had a really good 2018, fairly strong increase in growth that continued through most of the year. Most economists, certainly at the Federal Reserve as well, expect that was really a high point for this cycle, that we're likely to see growth decelerate to a slower pace, something closer to 2% rather than above 3% where we've seen recent numbers, right? So there is some slowing down. We should be feeling that over the course of the year for lots of different reasons we just talked about, right? But, right, then that leads us into the actual question, right? Is any time the growth slows down, right, well, it must be a recession 2 years in the future, right? And that 2 years is not a joke, right? That is, in fact, what you'll see a lot of economists say is that, when we have a recession, well, it can't be now. It can't be really in the next year because it's not clear that the data and the momentum have turned enough to generate a recession. Well, so when's it going to be? Well, it's going to be in 2 years, right? Why? Well, because, right? Because we want to hedge our bets, and that's what we say. Right? It turns out, though, economists really aren't that good at knowing when recessions are, right? We just aren't, right? So why is that? Right? So why is it that this big momentous thing that thinks like every economist should be studying and researching and understanding is so ridiculously hard to predict? Right? Well, one reason is that hardly any economists are doing this in relative terms, right? We've got 20 economists at the University of Oregon. I'm probably the only one that cares about this, right? They do lots of other very interesting things, but just not this, right? Recessions are super rare events, right? They're burned into our memories because they're painful events, but they're super rare. Since 1960, about 13% of the months have been recession. Since 1984, only about a little bit over 8% of months have been recession months. Right? And even that overstates the odds, because when a recession happens, all those months are grouped together, right? So it's not like every period we have an 8% chance of having a recession. If you don't have a recession this month, your chance of having a recession next month is basically zero, right? And that's the way that the chart works, right? This is non-farm payrolls since 1960. Growth in non-farm payrolls, and you can see the recessions, and you can see job growth goes negative instead of positive, and you say, well, there's a lot, but 1960 is a long period of time, right? That's not really that many instances of recessions, and when the recessions happen, they're all those months are bunched together, right? So these are fairly rare events, and rare events are hard to predict because we don't necessarily know what causes all of them, right? What dynamics are in play? What creates that coordinated pessimism to all come together at once to get people and firms to seize up on their spending so much that the economy, which is naturally resilient, actually starts to move into a negative growth position. Right? So what are the indicators we think of that might be important? Right? Well, one is, and you might have heard this in the news, something about this yield curve. Right? What the yield curve is just the interest rates of different maturities of treasury assets. They could be other assets, but different maturities of treasury assets. So treasury bonds, 1 month, 3 months, 6 months, 1 year, out to 30-year treasury bonds. And each of those has a different interest rate associated with it. A steep yield curve means that longer-term interest rates are higher than short-term interest rates. So that's the green line here. So that's the day the Federal Reserve first started raising interest rates, December 15th, 2015, in this cycle. Right? Very steep yield curve. It tells you that people think the economy is going to be strong and the Federal Reserve is going to continue to raise interest rates, and so you should expect higher interest rates in the future. Right? A flat yield curve means that interest rates are expected to be fairly stable for a persistently long period of time. Right? That's what the yield curve right now is. It's super flat. And that tells you that maybe interest rates are actually at the peak of the cycle now, and are going to be fairly constant going forward. That's what you would get if you thought the economy was going to be very stable over time, not a recession, not a huge expansion either. That's a great, I like a flat yield curve. Now the problem is, it's not a problem. The problem is there's a lag. Come on. Ha. All right. So this is the difference between those long-term and the short-term interest rates. This is the spread between 10 and 2-year Treasury rates. And I know I've got a lot of lines. Every one of those lines is when the Federal Reserve hikes interest rates. And so what you can see is that this yield curve gets flatter and flatter, which means this number goes lower and lower, and it becomes negative ahead of a recession. That's what we call an inverted yield curve, right? So an inverted yield curve means that investor market participants think the Federal Reserve is going to have to cut interest rates. Why do they have to cut interest rates? Well, because we're going to have a recession, right? So, but it's also a long leading indicator. Could be 6 months, could be 12 months, could be 2 years, right? The yield curve inverts. It could be a long time before you get a recession. But it's been one of the best indicators, right? So you can sort of use this and develop a model of what's the recession probability of the next 12 months, the yield curve, right? And so this is a model I put together this week, because that's what I do for fun, is do this sort of thing, right? And it would suggest something fairly worrisome, right? And the worrisome thing is that this has a probability of a 20% recession within the next 12 months, which is fairly consistent with the probabilities you get ahead of other recessions, right? So, shouldn't this be something that's of concern, right? Well, not so much, okay, in my opinion. Right? One is because it's very hard for these kinds of models to differentiate between a flat yield curve and an inverted yield curve. Right? The models don't work very well at making those distinctions. And as a result, you can have periods where very flat yield curve persists for a long period of time, such as that period of the late 1990s that look like you should have a high probability of growth, but you don't have a high probability of growth. In fact, the late 1990s were a period of excellent growth in the U.S. economy. So what this is telling you is really a flat yield curve is saying, typically a flat yield curve comes before an inverted yield curve. So the model thinks, a flat yield curve means a higher probability of recession. But because it's such a long leading indicator, it could just mean we're in a period of fairly flat yield curve, which would be consistent with fairly solid growth for a fairly long period of time. The model's not very good at differentiating between those two things. But you'll see a lot of economists very much worried about this inverted yield curve or this flat yield curve because they're worried that this is foreshadows a recession. Right? So can we sort of improve on it? Can we think of other indicators that might help us look into the future a little bit more? Well, one of our favorite indicators, initial unemployment claims. So when you lay off one of your workers that's covered by unemployment insurance, they go to the office, they file an unemployment claim. Those are the lowest level right now since 1969. Right? That's part of that structural, part is the way workers are not as covered by unemployment compensations in the past, but part of it's just the cycle. The cycle just means that nobody's laying people off, at least in any large number. So this has tended to be a very good recession indicator, and because it's weekly data, we think it's a leading indicator. This is something that happens before job payrolls start to really decrease in the data, before unemployment falls. So typically we see initial unemployment claims rise ahead of a recession. Another kind of indicator is temporary help payrolls. We talked about this in Oregon. Same for the U.S. as well. That's not showing any reason to think that a recession is imminent. In fact, that still has been a positive number. It typically goes negative well ahead of a recession. So the yield curve is one indicator. If we look at other near-term indicators, are not so worrisome. So if I sort of expand my model a little bit, take my yield curve model and add in initial unemployment claims, right? Simple expansion. And see what the probability of recession is over the next 3 months. Right? Well, probability of recession over the next 3 months is exceedingly small, much less than we saw in the late 1990s. Right? So that tells me that, at least as far as I can read the data, which is a little bit late now because of the federal government shutdown, the near term is a fairly unlikely, or is fairly unlikely to be having a recession this near term. Over the longer term, to the extent that it's likely, only really reflects this fact that the yield curve is a little bit flat. And I don't think that's really a good indicator of a recession. I think it's really an inverted yield curve that's a good indicator of recession. So I kind of look at this and say, I see where people are worried. You should be worried at inflection points and turning points of the economy. When I kind of comb through the data, it's hard for me to see where there's a real risk unless we're really getting into lower level, C and D level data. Right? So what are my basic rules of thumb here? Right? Well, there's somebody with a card, too, that's supposed to be warning me, and I haven't seen... Oh, there it is. Got it. My rules of thumb are when the yield curve inverts, basically means 2-year interest rates are higher than 10-year interest rates, I start to think, we should be really looking for signs of a recession. We haven't had that. We've come 15, 16 basis points, but it's not an actual inversion. What I really care about is whether or not the Federal Reserve continues to hike interest rates after the yield curve inverts. That would suggest to me that there's a lot of caution in the financial markets, and the Federal Reserve is ignoring that caution. And then once I sort of am looking for a recession watch, when I'm on recession watch, I'm looking for these leading indicators like initial unemployment claims, temporary help payrolls, capital spending numbers, and I'm not seeing a lot of action in those types of indicators to make me particularly worried about a near-term recession. But those are the things that I'm looking for when I say, okay, am I going to actually predict a recession or not? I kind of have to say this, that a real saving grace for this economy is that the Federal Reserve is in a position where they feel like they can be flexible. I think the Federal Reserve has a large role in short-circuiting excessive pessimism before it really builds. And the Federal Reserve has interest rates now where they think it's at the bottom of their neutral range. And so the neutral range is that block in the far right-hand side and with the arrows. And then where interest rates are now is that first set of dots. So at the very low end of their range of neutral. This is the range where they think that they can stop raising interest rates with inflation being relatively low. Right? And since inflation is relatively low, the Fed has basically said, we're not in the position where we're interested in raising rates right now. Right? What that's basically saying is all those things that are worries about the economy, the Federal Reserve can act as a cushion against. Right? They can act as a cushion against because they can lower interest rates if they need to, or just say that they're not going to raise interest rates, change the future path of interest rates. And that creates additional optimism about the economy that helps short-circuit some of the negative momentum we saw in stock markets and financial markets at the end of last year. That is an extremely powerful tool that we have at our disposal right now. Right? And the Federal Reserve looks like they want to be able to use that tool to cushion against some of these negative shocks. Right? One thing I do like to mention, too, that I think is relevant and important here is I could be wrong, right? I mean, we do know that the economist is not the greatest forecaster, that we overpredict. I think we overpredict recessions, so we're more likely to predict them when they don't happen than predict them when they do happen. But in any event, it could be that I've totally misread the data, totally misread the markets. The people that are out there screaming about recession are, in fact, right. And then that gets you to the next question is, okay, suppose there's a recession. How deep is it going to be, right? Well, if I look around the economy, I don't see a lot of the sizable imbalances that would really be consistent with a deep recession. Right? So we knew that, say, in 1999, 2000, that stock prices were fairly high relative to past history, and that's essentially the track of this red line here, the blue line here, dark blue line, which is stock prices after a Federal Reserve started raising interest rates. And what we know is that capital spending in technology was very high. and there was a lot of room for a downturn. And we knew in 2005, 2006, 2007 that there was large scope for a downturn in housing, and this could have very wide-reaching effects. So there were clear imbalances in the economy. I mean, taking the steam off stock markets twice this year suggests to me there's not a lot of imbalances in asset prices. Housing prices nationwide have started to grow at a slower rate as affordability has really become constrained. We're not seeing a huge buildup of construction activity. We're not seeing a lot of investment overall that's sort of outsized relative to the size of the economy. So I look around and I say, okay, if we have a recession, how bad could it be in relative to the past two recessions? And I think, well, I suspect there's not as much room to fall. There just simply isn't. So then I think, well, what's it going to be more like? Well, maybe it's going to be more like 1990. Right? Well, 1990 was a pretty smooth recession for Oregon. It didn't really have a huge impact on our statewide budget. It didn't have an impact on our local budgets. So from that perspective, it was good. Job growth slowed, but it wasn't the disaster we saw in the last two downturns. So I kind of look at this and say, sure, if we have a recession, it's not going to be great, but we shouldn't think it's going to be like the last two. The conditions that drove those recessions just don't seem to be in play at this time. So that is where I'm at with this discussion. And I do have a few minutes left for questions. I wasn't sure I was going to get through all the slides today, but we made it. Coffee is a great thing.
This is my...
Oh, hi, Bill.
And so I'm interested in how did you survive 35 days of not getting access to federal information?
Sometimes having a bit of a break to clear your mind is not necessarily a bad thing. And so that's kind of how I viewed it. But some of my indexes are delayed as a result of it, and I get a little bit anxious during those periods of time. It is lucky that some of the highest importance data, such as the job data, is still going to be released on time. So we still get some of our highest quality data despite the shutdown, but we'd very much like to not have these shutdowns go on very far. They create a lot of uncertainty across the business environment that is just simply unnecessary.
This is my Black Swan moment, annual perennial one. What do you see the Black Swan for this?
I don't. The Black Swan is by nature unpredictable. So I don't try to predict it, is what it amounts to. Is that there's all sorts of arguably large risks out there, right? I mean, I don't know if Brexit, if you had a hard crash of Britain out of the EU, what would be the knockoff effects on the global economy? There's always the story, we could have, a war with North Korea. Things like that certainly are always hanging out there. But by definition, they're kind of these such random events that I could talk about them, but I don't have I worry that if we talk about those random events, that they become too much of our outlook, right? And one of the reasons that it's really easy. I'll tell you, here's how you get famous as an economist. It's really easy, right? If you start a blog and you complain about the Federal Reserve every day, and you claim we're going to have a recession every day, and you want to sell gold, right? You want to sell gold stocks, right? That's how you become famous. So there's lots of famous voices in economics that basically sell fear. And I try not to sell fear. There is going to be a fearful time at some point in the future for some Black Swan event, but I don't like to overweight those events. I prefer to sell optimism because the U.S. economy is remarkably resilient. I mean, look at the growth over time, the growth of stock prices over time, the growth of standards of living over time. It is remarkably resilient. And it's resilient because every day we have to wake up and go to work, right? And so at a certain point, all of the noise goes away when that alarm clock rings, right? And that's what happens basically to everybody in this country. And that that need to go to work creates, I think, a substantial amount of resilience that is underappreciated. And so that also leads us to, I think, over-forecast recessions and under-forecast the good times. Right? Sorry, that was a long answer. Sorry. There's one here.
I'm going to take the mic from somebody else, but Tim, one of the outliers in the southwestern part of the state is wildfires, and I know it doesn't show up in a lot of data yet, but we know it's a very real impact on our southwestern Oregon economy. Are you guys doing anything to study that?
Well, I'm not directly. I'm certain the state is worried about this particular issue, and it's not just southwestern Oregon, eastern Oregon as well. We get that smoke in Lane County for extended long times, and it is a challenge that we as a state are facing as a result of climate change. Is these more destructive wildfires, and these more the greater persistence of them, and the weather systems that hold the smoke in our regions are going to shift patterns of economic activity. Things that I've noticed is, I try, where I would take my vacation in state, maybe I take my vacations in state earlier in the season rather than later in the season, right? And so it'll shift around our patterns of economic activity. These things probably aren't going away at this point, and we have to start to learn how to manage around them. Because it's already happening and upon us, and it's going to take a long time before the environment adjusts to that new event, which is basically removing a lot of the kinds of trees we have and replanting them with more fire-resistant kind of trees. That I would expect to happen over the longer run, but in the near term, these are going to be costly events that we're going to have to learn how to manage our lives around. All right. Thank you.